most of our brokers are going to have life and health licenses. What can someone with a life and a health license sell? Obviously, a lot of our focus has been on Medicare. In Medicare, what are we selling, Jackson?
Medicare Advantage and Medicare Supplements.
Medicare Advantage. We'll put MAPD, Medicare Advantage prescription drug plans, or standalone prescription drug plans, if any are actually commissionable anymore. MedSups, also known as Medigap, same word. Medicare Supplement, Medigap, same shit. Most commonly plans F, G, N, an honorable mention to a plan called a high deductible G. After that, it's mostly ancillary health that's cross-sold to these people. When someone gets a Medicare Advantage plan, it's typically zero premium, but there's out-of-pocket, like hospital copays, all these different things that they have to pay that are a little more than they would pay on a Medicare supplement. So in most cases, they're getting a hospital indemnity plan to go with it. Okay, so HIP would be a primary cross-sell for the MAPD market, but they still might do cancer, heart attack, and stroke. DVH is dental, vision, and hearing is a lot less common for Medicare Advantage because a lot of those plans already have a significant dental benefit in it, but it can happen. In the Med-Sup world, you would find, I'm just going to put this, in the Med-Sup world, you're going to find more DVH and CHAS cross sales. A HIP sold with a Med-Sup makes very little sense because a hospital indemnity plan, the core benefit of it is it pays a daily hospital copay. So if I have a hospital indemnity plan, the core benefit might be we're going to pay, if you go to the hospital, we're going to pay $300 a day for 7 days. That would be a very standard core benefit of a hospital indemnity plan. Well, if you have a Medicare supplement plan F, G, or N, you don't pay anything to go into the hospital. So having a hospital benefit like that would be redundant coverage. Doesn't mean you can't have the plan, you can have it, but why would you sell someone that when they already have that covered? However, dental, vision, and hearing, when someone chooses a Medicare supplement, they're staying on traditional Medicare, they don't have dental, vision, and hearing benefits, other than some extremely nuanced small things that Medicare authorizes, like surgeries like cataracts are covered by Medicare. But very, like eyeglasses, routine dental, implants, dentures, that kind of stuff, not covered by Medicare. So a standalone dental, vision, and hearing policy could cover that. A lot of these are like reimbursement policies, so they're not network policies because a lot of dentists don't like those. Cancer, heart attack, and stroke will also be sold. One, to cover out-of-pocket relative to medications, because medications can be very expensive when you have cancer. But if someone has Medicare Advantage plan if they have a Medicare supplement and they have a standalone drug plan, there's a $2,000 maximum out-of-pocket on drugs now. So that's only a small amount, but someone could have a $2,000 maximum out-of-pocket 2 years in a row. Let's say they get diagnosed with cancer in December and they get put on Revlimid and they hit their $2,000 max out-of-pocket. When January it starts over, now they have another $2,000. So that's $4K in cancer out-of-pocket. But then also, guess what? You're in Tupelo. You're dying of cancer. Are we going to trust the oncologists in Tupelo? Or do we want to go to MD Anderson or Vanderbilt or UAB? So now there's all this other stuff like travel, hotels, gas, eating out because you're at disposition. So having a check, so cancer, heart attack, and stroke, typically we're selling in the Medicare market $10,000 to $20,000 lump sum benefits. So they're diagnosed with cancer. Here's a $20,000 check. Plus you still have your Medicare and your supplement covering the majority of everything. But this is money you can now use for those additional out-of-pocket expenses that are just not covered by the traditional Medicare portion. So that's the most of what we sell in the Medicare market. Now, you have a life and health license. You can sell health insurance. Well, health insurance, technically this is all health insurance. But health, as I'll talk about it in the under 65 market, we have other plans. Jackson, what do we got?
We have ACA.
ACA, AKA Obamacare, ACA, AKA, also known as. What does the ACA stand for, Aaron?
Affordable Care.
Oh, dude, you're there.
God, you got Affordable Care Act.
Yes.
Oh, wow.
Boom. Good job. I didn't expect that, Aaron. I didn't expect you to get that.
I did not expect that.
What else is it referred to?
Don't get it twisted.
If you're trying to, let's say you're selling to a Mississippi Republican, what do you? But you don't want them to get ACA. What do you call it?
You don't want that damn Obamacare.
There you go. ACA, also known as Obamacare. So when you want them to buy it, you call it ACA. When you don't, you say it's Obamacare. Or if you really want to buy it, you just call it Trump Care, right? So, all right, let's see here. All right, so then outside of that, in the under 65 world, what are the other core products that people might buy?
We have short-term.
Short-term medical, which just made a huge comeback. So short-term medical is a major medical policy that it's been in and out of competitiveness since Obamacare was signed, because initially they made it where you could only buy short-term major medical policies after Obamacare was signed in like 30-day increments. Under the first Trump administration, they pulled that regulation back and said you could buy it in 12-month increments, and then United Healthcare and Allstate created these products called tri-terms, where you could get a short-term medical for 3 years in a row by selling 3 12-month policies bound into one. So you get 3-year major medical, not ACA. This is more of like when somebody doesn't get a good subsidy on the Affordable Care Act, they can't qualify because their income is too high, then they might look at short-term medical. Now, there are some cons to it. It's got a lot of pre-existing condition exclusions. It is underwritten. You have to answer health questions to get it. But in the case where someone's looking at, a full premium of $1,500 here, and then over here they can get it for $600 a month, a lot of them will choose that, even with the exclusions or limitations. There's another product called
I see the I. I wasn't going for the I. I was thinking, Christian.
Indemnity.
Indemnity. Yeah.
So a lot of people sell indemnity health plans. So remember I used this word up here, hospital indemnity. So an indemnity as a concept with insurance means what?
Indemnity. I don't know I know the concept. I don't know the exact definition.
What does it mean to pay as an indemnity plan?
It's going to pay a lump sum amount based off of a service.
A fixed amount.
Fixed amount.
Based on a service. So the difference is if you have a true major medical plan, like if Medicare or ACA or even short-term medical has a concept where it's like, hey, you're going to pay 100% of your cost up to this deductible, and then we're going to pay 80% up to this maximum out of pocket, and you pay 20%, and then when you hit that, we're going to pay 100% up to this. You're like, that's like percentages, and that's like kind of what we would think of as traditional major medical concept. Indemnity is going to pay a fixed amount per service. So they came out with these kind of plans. This was pre-Obamacare. They came out with this a long time ago, where you have indemnity plans where it says like, okay, Aaron has an indemnity plan, and he's paying $300 a month for it. It's a Manhattan Life Affordable Choice Elite or whatever. And he goes into the hospital. Well, that plan might pay a daily or a first hospital admission benefit of $5,000, and then a daily benefit after that of $2,000 a day. So instead of like up here where the HIP is kind of designed to supplement Medicare Advantage, this is designed to have such large indemnity benefits that it pays the majority of your bills in most cases. Now, it has limitations as well because it's underwritten, and they can be really strict on the underwriting of who can get the plans, and there could be loopholes in it. For instance, I have rarely seen an indemnity plan that will cover kidney dialysis, so it doesn't have a benefit for it. But it will have surgical benefits and all these other things, and I'm not going to get into the weeds too much on that, but there's a whole training that could be done on indemnity plans. But they're good markets because There are people that are going to buy these plans through somebody, you know. Some agents like to be conscientious objectors, like I only sell Florida Blue ACA, or I only sell Med Sups. I don't sell Medicare Advantage because of prior author, whatever, bullshit. You know, it's just dumb. Their customers are saying, well, fuck you, I'm going to go buy it somewhere else. So we want to offer all options and know that it's nuanced. It doesn't mean everyone needs an indemnity plan, but everybody doesn't need ACA either. Everybody's different, okay? Because if we said everybody needs ACA, what are you going to do to the guy that's making $120,000 a year with 3 kids, no wife for second income, and his ACA premium is supposed to be, for him and his kids, is going to be $1,800 a month. He's just not going to pay it. He's going to be like, fuck that. So then, then he might get an indemnity plan, that he can get for maybe $500 a month, or he might get a short-term medical. Is he better off with nothing or one of these? Of course he's better off with one of those. So definitely a market there. And then the other ancillary, just like we talked about up here, these ancillary products in Medicare are heavily cross-sold in under 65. In the under 65 world, ancillary, you do a lot of HIPs to supplement ACA and short-term medical. You would do cancer, heart attack, and stroke to supplement indemnity a lot. It could supplement technically any of these, but with the indemnity plan specifically, a lot of times their cancer benefit won't be very strong. So when we do this, we're recommending agents write $50,000, $75,000, or $100,000 lump sum cancer benefits, because it's not just to supplement a major medical plan that's going to pay most of the cancer details. Like with Medicare, this cancer benefit is supposed to be for some prescription out of pocket and some travel. With this, we're talking about, this might be covering a portion of the actual cost of the treatment. So we write a bigger cancer. And then, of course, a lot of these people still buy dental, vision, and hearing. Up here, I forgot to mention earlier, there are a couple others, like home health care, that people do sell. I would not really see home health care sold in the under 65 space. I mean, I guess you technically could, especially with the prescription reimbursement, but it's almost like a gimmick more than it is like a true product need. Now, let's leave the health world for a minute. Life. What can I write with my life license? Okay.
Annuities.
Got term life. Who's buying term life? You guys.
Young guys.
Younger people, a lot of times, with kids. Annuities goes with their life license. Term life is made for people who have a period of time that they need a large death benefit to cover things for their heirs in case of an untimely death. It's not a life policy that you buy knowing you'll cash in on it. It is a what-if policy. So some people say, you shouldn't even buy term because it's probably not going to pay out anyway. But that's not true, because, it is true that it probably won't pay out. Most term policies never pay out. Why do they never pay out? Because most of the time you outlive the term. That's not a bad thing.
That's what you want.
That's what you want to do. Now, I have, for instance, about $5 million worth of term insurance. Right now, I probably have 15 years left on that, in that term. So it'll take me, I'm 37, so 47, 52. I'm probably not going to die in that time. But if I died in that time, my family will probably need that benefit more than if I died after that time, because my plan is to have increased liquidity at that point. And there's obviously, in estate planning, there might be the necessity for me to go and get more permanent insurance. But I also have a thing called an IUL, which is an indexed universal life policy. This is a permanent form of life insurance. And I have a $300,000 one. Now, these are often sold as investment type of life insurance policies. I don't like over marketing them, because they're made for higher net worth guys, surgeons and up, dentists, surgeons and up. It's not made for some of the people that it's sold to. A lot of people are like telling people not to invest in their 401k and to buy an IUL. If you have a matching 401k, you should definitely invest in your matching 401k before you go buy an IUL. But if someone has a big investment portfolio already and they want to add an IUL to it, it makes sense. So I'm not going to spend too much time on that, but I wanted to hit it. Then you have whole life, and whole life can turn into a few different things. Final expense is the most common one we talk about. And final expense, by the way, is the most recent kind of name for this coverage. A lot of people refer to it as burial insurance from back in the day. And then I guess at some point they wanted to market it as something else, so they started calling it final expenses. Because technically it's not just for burial, it's a death benefit, it can be used for anything. But it is a whole life policy. So you can get a final expense policy. Now there's this other thing called a participating whole life. And these are more like investment vehicle type of coverage as well. You write that really well. Ooh, probably should have took him to the front. Either way. All right, participating whole life. What are we looking at here? Participating whole life is and I'm not an expert on this field, but a lot of investment groups, instead of the IUL, will put people into a participating whole life. And there's supposed to be like a dividend paid on this policy where you're paying in a bigger premium. Like if I go get a $5 million term policy and I get a $5 million participating whole life policy, this premium is going to be substantially larger. But the goal is that they take part of that and put it into a cash value accumulating account. And then over time that policy grows, or that account value grows. And that's what people sell it for. Final expense operates like a whole life policy, but they create a premium that lasts for the rest of your life, but there is no big accumulating cash value account. So it's made for smaller benefits. So a lot of people are selling this in the $5K to $50K range in benefit, whereas participating whole life would probably be $100K plus. IULs would be something like that too, it'd be the $100K plus mark. Term life would be probably $100K plus as well. So pretty much anybody in this smaller death benefit world ends up in the final expense category, which is the most of what our distribution writes. So they're sitting, with a client, and then they want a $25,000 or $50,000 death benefit. Also, when they're older, it's more expensive to get something like this. Because guess what the odds of dying do when you get older? They increase. So some people will be like, it's just a shame what they do. It's a shame you didn't buy that policy when you were 35. I saw that you had a lot of four-wheelers. Cool. So anyway, I don't tell them that. Now, what happens if an insurance company goes into insolvency? You know what the word insolvency means?
Pretty much going to a bankruptcy situation. They lost the capital, their liquidities.
So the reason insurance companies don't use bankruptcy is because they typically never actually bankrupt. There's this term insolvency because they have required capital constraints. So an insurance company has to maintain a certain amount. The DOIs in each state require that they have a certain amount of money set aside to cover the risk associated with what they're insuring. And that changes based on how big they are and what they're trying to do. And if you're in the annuity market, there's probably a lot more money they got to have. If you're in if you're just doing hospital indemnity plans, it's probably X amount. But then if you're going to do Medicare Advantage, they're going to want a lot more money. So when they go into insolvency, it means they could just dip below that threshold. And then the state would come in. And it would probably initially be like, wait, is there a way that you can quickly get above that insolvency line so you don't actually have to go into what we're going to talk about next? This is called receivership. Because if they can't get above that capital constraint, that capital line, then they're in insolvency. They go into receivership. Well, there's this thing called the State Guarantee Association. State Guarantee Association. ASS. State Guarantee ASS. The SGA. I've never called it the SGA before, but it's a terrible acronym. It's gay. Anyway, so the State Guarantee Association, it's not made to sell on, so it's not something that you want to sell a customer on, But what happens if a carrier, but if someone asked, you could tell them this. Like, this is not something you sell on, but if someone says, well, what happens if the company goes bankrupt? This is how you would explain that. The State Guarantee Association, anytime an insurance company in a state goes into the market, that state requires them to pay into the State Guarantee Association. And that State Guarantee Association then insures against the risk of them going insolvent and thus into receivership. Yep. And then the state takes over the claims. So whether it's annuities, life, Medicare, they would take over processing the claims
State
for that
takes over the
company.
claims.
It's happened a handful of times. Like since I've been doing it, I had one annuity company that it happened to was Colorado Bankers Life. And we've written a few of them, and nothing for the customers. Nothing happened. They get like a notice that it happens, but it really didn't change anything.
So I mean, it kind of sounds like being double insured, like insuring the potential.
Yeah, it's like
claim.
it's like reinsurance. So
The reinsurance. But so even though you have that, can you also then get? Because I know there's some companies that do some reinsurance on the back end.
yeah, so like if you look at a smaller carrier that gets into a market that requires higher capital constraints, they'll normally, like a Medicare supplement market, when you see American Home Life launch a Medicare supplement, their office has 15 employees, or 10 employees, like really small. So they don't have the money required by the DOIs that they go into to do that. So they go to Aetna, they'll go to Mutual of Omaha, or they'll go to a company like Swiss Re or some of these capital groups that will supply the reinsurance capital, meaning they put the capital up. Now, when they do that in Medicare supplement market specifically, the reinsurance company actually makes like 98% of the profit in return because they're the ones putting all the capital. Yeah, they get all the capital returned at later once the premiums have built up enough capital to be there, but the carrier, the TPA, only makes 2 to 8% or whatever on the actual margins.
They're not scared to go high in the loss ratio.
Well, right now they are, but the reason is it's all based on how affordable it is to borrow money. So it's all tied into yield curves and bond markets. Like when an insurance company can go and grab money and then put it over here, but grab it cheap and invest it in something higher risk. At the same time, if the Medicare supplement claims are going up and the margins are decreasing, then it's expensive to go get capital, then I don't want to go put my expensive capital into a low yield investment.
Down, use that capital maybe to open up like a new book.
Yeah.
And then run it that way.
So the biggest reason I bring up State Guarantee Association, one, I'm just trying to teach you guys stuff you don't know, but State Guarantee.
I've never heard of this.
Yeah, so the State Guarantee Association is a good thing to sell against. So you don't sell with it, but if somebody says, well, in the bank, I'm insured by the FDIC.
It's like the backup.
Yeah, State Guarantee Association is the FDIC for insurance companies. So, yeah. I'm a young aggressive investor, or moderately aggressive. I wouldn't say like super aggressive. Annuities are security-minded people, so it's like I've saved this up and I don't want to lose it. I like to have a certain amount of liquidity, very accessible, and that's all relative to someone's situation. There was a time where I wanted 10,000, then it was 100. Now I wanted $1 million in my personal checking account to feel like I'm just good. Without it, I feel just different. It's just a different. But I got a lot of expenses. Like a lot of things are going in and out all the time. So defaults change. When you see days of making $1 million in a day and spending $1 million in a day, $1 million changes to you really quick because you're like, okay. If I can spend $1 million, and I'm not talking about on boat, I'm talking about on business or investments or something. But like when it can go that quickly, you're like, okay, I have to have that because without it, I could get myself in a pinch too quick. So it's just different. But for everyone, there's that mark. My recommendation on a personal finance level to people is to find that mark that's aggressive for you now, hit it, and then make that your baseline zero. So if I need 10 grand in the bank, once you hit 10 grand, the next one might be 50 once you hit it. Like, treat that as zero. Once you get to 100, it's zero. Those are zeros. You don't get to go under it.
10,000 is broke. You can't
Yeah.
go.
If you got to get to 10,000 as being broke, then you're never below 10,000. 10,000, if that's the goal, once you get there, you should feel sick to be under it. Now, based on the video I sent you guys about relationship with money, he would probably disagree, but I'm.
Completely opposite. I watch that.
Yeah.
I started it.
So the point of that video and the reason I do like it is it's, you have to, we're playing the money game for a reason. It's a 2-hour video, but so I would just listen to it on rides and bits and pieces. But he talks about like people retiring, for instance, and going back to work or trying to find something to do because they get bored, because the goal in life is independence plus purpose. And so people that retire have established independence, but they have no purpose. And then people that have purpose, but they don't feel free, haven't established independence. So everybody's trying to look for independence plus purpose, and without either one. I actually think purpose in and of itself is more fulfilling than independence. I think independence sometimes becomes a target, and then you hit it and you're like, what does it really mean? What am I doing differently, or you do some things differently and then you kind of reel back to like, I prefer purpose. So back to health. But wait, there's more.
Wait.
All right. Long-term care, short-term care, and disability income. This is another product set.
I understand why they didn't put the C on there.
Yeah, these are health license products. So in long-term
Where
care,
did the state guarantee
I'm aware of the state guarantee.
yeah, Will's been around for a long time. So long-term care long-term care is a product built to pay for private stay nursing homes. So if you have, this is typically going to be, upper middle class folks that aren't going to have they don't want to go into a Medicaid paid for, or they're not going to qualify for a Medicaid paid for long-term care facility. Medicaid paid for long-term care facilities suck. If you've ever been to one, they're
single ply toilet paper.
It's going to be bad. It's going to be bad. But there's private ones that are much better experiences, and long-term care insurance will pay them. So it might be something where it has an $8,000 or $10,000 monthly benefit amount for 3 years, 5 years, 7 years, whatever they've set out to cover. One of the only carriers with traditional long-term care right now is Mutual of Omaha, and the policies are expensive. You might be in the $400 to $700 a month range, and the first year commission might be like 50% or something. So it could be pretty substantial, and then even the renewals could be substantial. But because it's so expensive, and because a lot of people wait too long to get it, because it is underwritten and it's not easy to get, like you have to qualify, they might get a short-term care policy. Now, short-term care policy is basically the same concept, but a maximum of 1 year. So Aetna has a plan called Recovery Care, and it is a short-term care policy, and you can build it up to 1 year that basically would satisfy this. And it's a great policy, and you're talking more in the $80 to $200 a month range, depending on someone's age and all that. And the health underwriting is a little less strict. First year commission's actually higher too. So,
Still got one on the books from 2018.
do you? See? Disability income. Now, what is disability income? It's insuring your income against disability.
Oh, yeah, okay, that's it, yeah.
Okay, so let's say you have a friend who is a doctor, and like almost every friend that you have that's a doctor or surgeon especially will have a disability income policy. Most of them will get it through Northwestern Mutual for some reason. That's just that company targets them when they're in med school. But any person that has a substantial income might want a long-term disability income policy, because you could get it to where it pays 60 to 70% of your income for until you're 65 years old. If you get, let's say you're a surgeon and you lose your arm in a car accident, probably not going to be a surgeon anymore, right?
My dad told me about this. He had one for him for like dental.
Yeah, a dentist would definitely have one. Because if you had, like, if, let's say something like that would have happened to him, like being a dentist would be difficult without hands. So if you didn't have hands all of a sudden, or something else, I mean, you get paralyzed, or you have some sort of damn brain amoeba that makes you marshmallow, or I don't know, any number of things that could happen. It could be a psychological illness, something that just makes it where you're incapable of doing that job anymore, and it triggers this benefit. Then you could have it set up. There's different ways to do it. You could do like a 10-year benefit, a 20-year, 30-year. I had one for a long time that would pay until I was 67. I think that's the max you could ever get one to pay. And it would have paid 60% of my income at the time I took it out. So if somebody's got their income is, let's say it's $30,000 a month, which is a lot of doctors would be, could be $30,000, $40,000, $50,000 a month, and you're paying 60% of that. It's a big benefit. And so this policy is more for your higher income people, because the biggest fear that they'll have is losing their income. They don't have a lot of liquid wealth. They have an income, and the income is what's paying for everything. So that's their biggest asset. Those are some other markets. Anyway.
You said that lasts till they're like 65?
It can. It depends on how you sell it. So when you buy it, you can buy a 10-year benefit. So it's cheaper if you just buy a 10-year benefit. So like, let's say I'm 37 right now and I wanted to insure my income 60%, and they approved it to insure that. But I was going to buy a 265 version of it, and that was going to be, for me, something really expensive. Yeah. And then they were like, well, we can do a 10-year guarantee, and it's going to be 25% of the price. So I might say, you know what, I think I'm comfortable with insuring just 10 years of that income and to paying less. There's a risk-reward ratio. So I still don't think anything's going to happen to me, but if it does, I get 10 years of my income. That can establish a time period where my wife could figure some other things out, or we could reduce our living expenses, and those are all, I think I bring all this up because it's just, the more you know, the more like everything's an opportunity. Like obviously Medicare, individual health, huge markets, life in general, there's huge markets in all these. And you don't want your agents to be like overly distracted, but in a period where there's some sort of ambiguity in like what plans here, paying commissions or whatever, knowing like how I can help somebody with this, that, or the other, especially when you start talking to first-year agents. Of course, it's a pain in the ass to know all these things, but if they know that they exist and they don't spend time learning about them until they run into a prospect, but that prospect could be huge. If I'm a first-year agent and I'm really struggling and I run into one indexed annuity that's $250,000 and I make 20 grand, that 20 grand I could live off of for a long time while I'm building my other stuff up. It's not like I don't need a $250,000 annuity every week. I could get one a quarter and be like, and do really, really well, right? So I think it's just important in that realm. And I
know you've been talking about the annuities a lot. Are we wanting to establish a team that just focuses on that here?
Eventually. Right now, I think that I think that as a business, we still, like, over time, what businesses do is they start out extremely, if you're a team of 1 to 5, no one's a specialist. Everyone is doing everything, right? And then as you go, let's say when you're on your path to 100 employees, the further down that line you get, the more you start to carve off specialized tranches of your business. But there's still a degree of like specialty can be, like there's not a time where every single task can be too specialized because it doesn't financially make sense yet. So I don't want to build a financial services team when right now we could just our own recruiting team could find and build, our contracting team, recruiting team can build some of that prosperity. And then once the income starts coming in from it, then we might start, okay, let's hire some people to focus on annuities, or let's hire some people, or maybe somebody within the team kind of branches out and says, I want to focus solely on annuities, and then they focus solely on annuities, and then we fill their spot with a new person or something. When you think about when we started, though, Medicare agents wouldn't come to us.
Really?
So it's always that way.
Show them something first.
Yeah, you have to show them. So everyone that you like look at and you're like, wow, look at what they did. There's a time where people were looking at them like, look at this dumbass. What is he doing? And then eventually, you know what I mean? Like they're here, but they were stumbling through to get to that. So like we didn't contract my first
See, I hadn't been
6
here long
years.
enough to, like, see the evolution.
Well, I mean,
Yeah.
you're still like, we got people who've been kicking tires for 4 years saying, I'm coming, I'm coming. I'm
Yeah.
coming," And they're still not. So-
We have the first 6 years, 7 years, we didn't contract downline agents at all. We were just
So what
trying
year
to.
is this? What are we in?
For me, it's, this would be my 10-15, yesterday was my 11th AEP started. So in February, I'll be 12 years in the industry. So, but we didn't contract any agents in that period,
Just for 2020.
in that first 6 years. 2020 was actually so really what happened was 2020, we contracted maybe a handful of random ones in 2020. But 2020 was when I quit selling and started kind of focusing on the conference and some of the university stuff. And then COVID happened, which helped accelerate some of my content production. Even though it was all shitty, I was doing it at home myself. And then in 2021, when we had the first Medicare con, we hired Sid, and then we started recruiting a little bit. But it really wasn't active recruiting. It was just like letting people know online that we were contracting people. So the current evolution right here is we didn't have a recruiting team. You guys are a recruiting team now. And even now, we have specialty kind of recruiting teams. Like, I would count you two as basically recruiting. But he's like marketing hybrid recruiting. He's like sales training hybrid recruiting. He's like technical hybrid recruiting. So we're still doing it in a way where it's like not everyone is specialized in recruiting. But in some ways, those become your superpowers because he can recruit from his process. People are wanting sales training, it's going to help him recruit. People are wanting to do marketing or wanting video, it's going to help him recruit. So it's not a bad or a good thing. It's just the way it is. So the diversification is because you don't want to be focused on you don't want to be too unilaterally focused, especially Medicare Advantage has taught us that this year. There's definitely changes. And we're not scared. Like, we think those are resets and we're growing through them. But if you were one of the biggest old school FMOs in the country this year, you're losing money. But the reason we're gaining it is we're gaining market share. So we're gaining market share faster than any opportunity is lost.